time to start preparing your portfolio for the 2008 market. Some market analysts predict we'll see some changes this year from the bull market we've been experiencing since 2009.
Yeah, this morning we welcome Jim Heafner, president of Heafner Financial. He's a certified financial planner, and he joins us every Wednesday, as I mentioned, to help us get financially fit. You're a good man to get out there on the roads and be here with us this morning.
Rain or snow. Don't worry, we're here.
We still have to plan for retirement. Yes, I know. No, we would have understood if you had canceled, but we're glad that you're here. Stocks shot up by 22% last year. So let's start with an overall outlook for the market for 2018. What can investors expect this year?
Well, Vanguard and JP Morgan say expect a lower performance, 3 to 5%. But when you think about it, what we do every day is we try to predict the likelihood of a recession so that if we see it coming, we can get our clients out of harm's way. Now, we're not perfect, but we're pretty good at that. We don't see anything on the horizon. Things look pretty good. Now, you add to that the huge tax cut that corporations got beginning this year from the new tax law, and we think that we'll see a better return than that this year. So things look pretty good. Now, having said that, there's always bizarre things that happen, so stay tuned.
Yeah, that's true. So what can investors do to prepare their portfolio for 2018 with all the climate you just said?
Well, the first thing I would say is to make sure your portfolio is aligned with your risk tolerance, your willingness to take risk, and see your portfolio go up and down. So there's no point in taking risk you don't need to take or risk you can't afford to take. So it's got to be customized to you. And don't just go for the gusto. Look at your situation. Can you afford to lose money?
Okay.
Number two, I'd say, is you want to diversify. Diversify beyond stocks and bonds. There are other investment options besides stocks and bonds. And number three is to be careful of bonds. Why?
Be careful of bonds.
Be careful of bonds because, you know, interest rates are rising. We've been at the bottom after a 40-year decline of interest rates. Rates, 3 increases last year by the Feds, 3 more this year coming. So we know rates are going to rise. When rates rise, bonds lose value. And most of all, long-term bonds lose the most value. So don't buy long-term bonds now.
You know, when you buy any type of investment, there's always some fees associated with it, right? So
yes. How
can fees erode your portfolio and your plan that you want to do?
Well, obviously, you know, fees are an important part of the mix. You can't be there without fees.
Exactly.
Right? So, but you can, if you'd like to be a passive investor, you just buy a fund and let it do its own thing, or buy a stock and let it do its up and down thing, then you can buy funds that are ETFs or index funds that has no management to it at all. It just rides the market.
So they just rise up and down. You don't have to pay
You're not paying anyone to watch it and move it and buy it and sell it, right? So that can cut your fees. So those are out there. If, on the other hand, you like active management where someone's watching your money every day and can move it out of harm's way or take risk or less risk, then that has a fee associated. And you want to know what the fee is. Now, I got to tell you, it's hard to know because there are a lot of hidden fees in most all accounts. Right?
Yes, and those are the things that maybe get some of the investors upset because they don't know about the hidden fees, and because they don't know about the hidden fees, they're taking a bigger hit that's messing up their retirement.
That's right. You want to ask your advisor, please show me all the fees I'm paying, because there's more than what's on your statement, typically. So you want to know that. But if you're an active manager, if you want to have your money managed by an active guy, you're going to pay a fee. Now, having said that, if I can get 10% a year after the fee, I don't care what the fee was, right? So it's like if I'm having brain surgery tomorrow, I don't want the cheapest surgeon.
Absolutely.
It's all about value, not just fee.
So, Jim, all this being said, what's the best way we can ultimately prepare for the unexpected?
Well, you know, if you're in retirement or close to retirement, it becomes pretty critical. If you're 30 years of age, you can just throw it to the wind and hope it does well, and you're probably going to be okay, at least for a while. But if you're close to retirement or in retirement, you don't want to plan based on hope. Hope is not a good plan, right? So you want to have a financial plan in place that's going to let you lead your lifestyle as you choose without worrying about the market every day. So that means find a financial planner, not a financial advisor, but someone who is licensed and trained in planning. And then make sure you have a plan created for your situation, your assets, your spend level,
your risk tolerance.
Your risk, exactly. All those things that are relevant to you needs to be part of that plan. And make sure that your plan is based upon research from Harvard, Wharton, Boston College, Centers for Retirement Studies, Texas. These companies or these entities that don't make money on your decision. When you see a recommendation supported by research that that's done by a company that makes money when you give them your money, be suspicious. But
Jim, thank you so much. If you need help with your financial future, enlist the help of a trusted financial professional like Jim. The first 5 qualified callers to Heafner Financial will receive a complimentary, no-obligation financial review. The number 704-552-1230. You must have a minimum of $500,000 in investable assets to qualify. Again, the phone number to call, 704-552-1230. You can also visit Jim's website. It's you'lljustknow.com. Jim Heafner, thank you very much.
Thank you.
Drive carefully.
Indeed. All right, well, come